Thank you for joining us again. This is Robert Schein, Managing Director, Partner of Blanke Schein Wealth Management. Thank you for joining us for our Friday Insights edition. Today is September 30th of 2022, and it's the end of the third quarter. A lot has happened within the markets. We're going to look at a long-term historical perspective today, as well as setting us up for the future and to say, hey, what do we expect? And, most recently, if you saw, I was on CNBC yesterday at Worldwide Exchange early in the morning, and I was just talking about how we are positioned properly for our clients. Our process really weathers the storm. If you think about it, with Blanke Schein Wealth Management for over 40 years, in over 100 years, 40 years of serving clients, multi-generational, as well as over 100 years combined experience. We've seen markets and bear markets like this before, and we've been successful with our clients on the other side to higher highs. In fact, that's the first chart I want to show to bring into historical perspective of what a bear market looks like, but also what the bull markets look like. And as we have this image on the screen right now, you're looking at the S&P 500 and the cumulative returns, and basically a broader long-term time horizon of what the S&P looks like over time, going back to 1926 to 2022, including this year. And essentially for the first half of this year, we have a drawdown of 20%. As well as you can see on your screen right there. But you're also seeing the green. The green is what we ultimately love. In fact, every investor loves, and we do here as well. And that's just the expansionary times in our economy, no recessions, so on and so forth. But we have to go through some of the red, or the drawdowns, or the recessions to get to those higher highs in markets. As you can see, historically, we have seen this time and time again. It doesn't feel good when we're going through a bear market, but at the same time, it's a great opportunity for us to rebalance and use our process to our advantage. By that, I mean there are some areas and some sectors of the economy that we like to overweight moving forward, such as energy, materials, industrials. That will be the next sort of regime as we pull into the next bull market. And those that are tech heavy, as we are with most of our clients, really have seen some outsized returns, some unbelievable returns over the last decade or so. That doesn't mean we go and rush to sell them, because they are quality and we love quality, and some of those pay dividends, so we get paid while we wait. Also, we have to have tax implications on mind. We don't want to sell just for selling and then have to pay taxes and say, hey, wait a minute, I shouldn't have sold because I want to buy back again. So we're not day trading or timing market or anything of the sorts. We're just taking a long-term perspective and saying, hey, listen, we've got some of our portfolio, large cap growth, tech, think of it that way, that has done exceedingly well for us. But what, as we transition moving forward, as we have cash to put to work, as we do some strategic rebalancing when the time is right, where do we see opportunity? And again, like I said, energy, materials, and industrials, and we'll start seeing more of that in the portfolio because we see value there based upon the price to earnings ratio. But that being said, ultimately, as I was on CNBC yesterday morning and I discussed, the markets will soon turn towards profits and earnings again. That's what drives the markets. That's what we said in March of 2020, in April of 2020, when we had a 40% drawdown in the equity market because of the fear of the unknown of the pandemic. But again, I pointed to back then, as I'm pointing to right now, the earnings is the underpinning of what keeps markets moving, not only moving forward, but moving higher ultimately. Now, this year's earnings season, right now, the average earnings growth is 9% for the S&P 500, historically speaking, over the last decade, all in, if you even include what we saw with COVID. Right now, the earnings is trending just above 3%. So earnings estimates have been lowered. Expectations have been lowered. We believe that the third quarter, we don't know what the earnings will be, but we believe that corporations will be able to meet and exceed basically the estimates, and earnings will come in better than anyone expected. That could set up for a relief rally. We also have midterms coming closer, and that will help us with the uncertainty. We will have more certainty as we get past the November midterm elections. And seasonally, in October, November, and December, we see a transition. We see sort of September, October, those are the flush out months. Those are sort of the repositioning months. And then we see sort of markets trend higher towards year end. We don't know if that's going to be the case. We believe that's going to be the case, but we'll be positioned for that nevertheless. That being said, why do I point to earnings? Well, if you look at the second chart that I'm going to show, this is a chart of the pre-tax corporate earnings, and it shows that second quarter of this year was the all-time most profitable corporate earnings quarter in the history of reporting. So while we have markets that are down and discounting mechanism of 20 to 30%, basically forecasting the worst case scenario, will corporate earnings fall out of bed in the next year or so? And that's what we're seeing play out in the market today. So we have a recession. We're embarking upon a recession. That's for historical economists to ultimately say in the rear view. We do know the consumer is slowing down. We don't believe the consumer is going to slow down and pull back consumption to the effect of 20 to 30% in their wallets. We don't see that happening. Historically, it hasn't happened to that magnitude, but markets still go through the worst case scenario. However, we're still going to be paying attention to what the third quarter earnings and what the corporations say. We believe they will throw the baby out with the bathwater. And why wouldn't you use this opportunity to say, hey, it's inflation, it's supply chain, we oversupplied. You have a lot of retailers that are just flushing inventory right now. So there's going to be a lot of good deals coming into Christmas season if you're a consumer. That being said, we will get through this and we'll see it on the other side, and we're going to position appropriately and accordingly, and then put some money to work. There's some quality, high dividend paying companies that are good quality cash flows that are looking at a reasonable valuation. So we like markets like these to put some capital to work in a rebalancing as we normally do. And that's our process, and we're sticking to it, and we're looking forward to any questions, concerns you may have, or even just talk, say hello. We'll be on the road for the next couple of weeks. I've got the Barron's Conference as well as a few other conferences, but I'm always accessible, available, so is our team. Thanks for watching, and we'll talk again next time.